Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Now, before we get started, just a quick plug for our live stream tomorrow, August 17, 2024, 11 a.m. Eastern. So that's tomorrow, Saturday. And we're going to go over a real life velocity banking case study of somebody who makes $5,400 with 22 debt payments and only has $4 savings left over. And we're going to review, like, wow, is velocity banking even feasible in this situation? So that's what tomorrow's live stream is going to be. It's only for members. So if you go ahead and click here, there's a join button on the YouTube channel. It should be here for you who are not me. And also you could click this link right here to join. I'll click it and then you'll see this, something like this, where you can join for 99 cents a month. So you have two additional perks when you do join. Number one is you get these cool emojis, and number two, you get exclusive access to a once a month live stream based on whatever topic I want to talk about or whatever I feel like talking about. So let's go ahead and get started with the topic, which is velocity banking. So this is just another clickbait video regarding Dave Ramsey, because who doesn't love putting Dave Ramsey's face on a thumbnail? So here's the thing. We all know that Dave Ramsey doesn't like HELOCs, right? You look up any on Google or on YouTube, Dave Ramsey HELOCs, he's just going to have this grumpy face that you're just this big idiot, right? And so if you go ahead and pay off your debt, right? Dave actually has an application where you could go on his show and do a debt-free scream, right? Ramsey Solutions, debt-free scream. Congratulations, you're debt-free. Did you know that more than $1 billion of debt has been paid off by debt-free screamers on the Ramsey show? Big deal, right? And then so, if I filled this out and say, hey, I did it with HELOC, he might be a little bit mad, right? In fact, he actually has a question. If we scroll all the way down, um, where he says, "Did you finance anything while paying off debt?" Right? Did you use your credit card while paying off debt, or do you still have one? And it's like, ooh, yes, I probably won't get on the show, but I wonder if anybody who does velocity banking and decides, hey, I'm actually gonna fill this out and try to go into debt free screen, because that's what we're gonna try to do today. We're gonna try to do the debt free screen. And again, one of the things I always talk about is when with Dave Ramsey, he has this thing called the seven baby steps. And with step one, when you're in financial trouble, negative cash flow, I don't even know how to do step one, right? But with velocity banking, in my opinion, it's pretty easy. Step one, save $1,000 for your starter emergency fund, right? Save $1,000. And he says it works every single time. Doesn't even matter what situation you're in. Every single time it works. And I'm just like, well, here's the thing. And I always show the spreadsheet, um, what I always call the financial stress test. Because what if you're making good money and you're broke, right? That's what velocity banking is about. Is that when you make the money, do you know how to manage your cash flow? Do you know how to manage your debt? And if you can't, that's where the emails come in. And again, I'm not like looking down on any, but I'm just saying that's where the emails come in, where people don't know why they're broke when they're making good money. I get unsolicited emails all the time. I might read them, I might reply, I may not, right? So just something to think about. Now let's go ahead and open up that spreadsheet. Give me one moment. And here we are, right? This is the scenario I go over and over and over again. Because what do you do when you're in a negative cash flow situation? $9,000 of income, and I know that people think, like, they see this like, this is not realistic. Look, understand the principle and then apply it to your situation, right? Because again, this is what I call the financial stress test. When they design consumer products well, and I'm not saying all consumer products are designed well. When they design it well, like kind of like a Nintendo Switch, they do tests where they drop off the Nintendo Switch. I don't know for sure because I never worked at Nintendo, from a high distance to see if it's going to crack. Right? Same thing with your finances, because if you do this when you make a little bit of money, it doesn't really make sense because banks don't lend to people who need money, right? But let's say we do make good money and we have more expenses than we have in money, right? More expenses, or also what they call more month than money, right? And we have negative $644. How are we going to save $1,000? Can anybody tell me how we're going to save $1,000 and do Dave Ramsey step one, so we can go ahead and pay off debt and go and do the Dave Ramsey debt free scream? I don't know how to do that, right? So that's why I'm confused when I look at Dave Ramsey's website, because step number one says it works every single time, or the baby steps. It works every single time. And you tell me how I get out of this with baby step one, save $1,000, because I can't do that. I can't do that. And again, I've shown you this table where it's like this is the credit card um, payoff, expected payoff, and how much you pay. And I kind of showed you previously, in order to save $1,000, it's going to take 7 months. But in order to save that $1,000 with 10 credit cards, you're going to pay like 24 grand in interest. Mind blown, right? But yeah, that's where we are today. And no way I could save $1,000. But here's the crazy thing: if I had a line of credit, right, a $200,000 line of credit, whoopsie, available to me. And again, we're not going to get this line of credit when we're at negative savings, because banks don't lend money to people who need it. This is why we have to learn our financial foundation before we start borrowing money, rather than just trying to fix it after the problems have occurred. It's kind of like medicine, right? Again, I'm not a doctor, but I've read many books from doctors who were saying things like, well, prevention is much better than the cure. That's what I've heard, right? So we kind of want to prevent this from happening. But let's say we did have access to a huge line of credit, $200,000. This would be a lifesaver for most people. This would be a lifesaver, right? It's a lifesaver, but not in the way that most people would think. Because right? Because let's say, and again, I'm going to go over all these terms again. But let's say you borrowed $1,000 from a line of credit, and people think like, well, if I just had this huge line of credit, I'd be okay too. No, no, no. Because if you have a $50 minimum payment on that line of credit, and you're doing things the average American way, then you just have more negative savings, right? And we don't want that. So let's go over some terms: velocity banking, line of credit. So in order to velocity banking, first of all, what is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. That's it. Main operating, those are the most important words. See, average American, their operating account is a checking account. We're not talking about how much money they make. People get, they see this, they get so confused. Stop talking about how much money they make. We're talking about what's their main operating account. Whereas velocity banking, it's their line of credit. Okay? So let's go ahead and do this. And I'll just all we need is two things: a budget and a line of credit as your main operating account. So let's go over to what a line of credit is. All it is a financial tool where you can borrow money, pay it back, and use it over and over again, right? So I could literally just go on a bank's website and click a button and say, I want $10,000, and then I got $10,000 in my checking account. That's cool, right? Like, I didn't even know that banks had products like that. I always thought about like, oh, only credit cards? Nope. Because credit cards, you can't go on a bank's website and click a button, say, hey, I want this. For the most part, maybe 90% of, I think there's some exceptions, but when I go into a credit card and I need to withdraw cash from my checking account, they're charging me like withdrawal fees, advance fees. I don't want any of that. I don't want any of that. That's why I like personal home equity. And I got credit cards too. I have over $284,000 in lines of credit. 284. Now, a credit card technically is a line of credit, so it's included in that pool. But hey, if I need that money, I have it now, and I got it before I ever needed it. You see what I'm saying? All right, so now let's go ahead and copy these expenses. So we assume pretty much the same budget, right? We assume the same budget. And then we're going to do something crazy that Dave Ramsey would think you're insane for, which is not save $1,000, but zero savings, right? Zero savings. And then we're going to have something called cash flow, which is income minus expenses. And you might be thinking, I'm just shuffling words. Well, this is the same. We haven't completed this budget or this side of the budget yet, because we have to make our line of credit as our main operating account, our line of credit. So this is what's going to happen. We're going to consolidate our debts into that line of credit. We got 10 credit cards here. Again, I always love this example because it's so dramatic. Because how do you go from negative $644 to a positive number without making more money? Most people, when they are in this situation, say, well, you got to make more money, right? But not if we make our line of credit as our main operating account. So what we do is we move that credit card debt as much as possible in the beginning. And then guess what? These payments all go to zero, right? They go to zero. Okay. And then now our cash flow is a positive. How do we get from negative 644 to $4,701. Can somebody, again, I'm not making this up. This is Excel doing their math. This is Microsoft Excel. So I'm not just doing this on a whiteboard where it looks impressive and you don't know if this is real or not. I actually just use basic Excel functions so you can do this. In fact, you can get a free version of Excel by going to live.com and trying this out yourself, or you just get it from Google Sheets, or you could just use LibreOffice, right? You just go ahead and do it yourself, right? And I actually made a free velocity banking spreadsheet available on the featured video of the channel. So if you want that, go ahead and get it, and don't bother me ever again about that, because I hate getting those emails about I want a free velocity banking spreadsheet, because I want you to do it yourself, right? That's the most important thing. That's the value of this channel. I just keep doing it over and over again. Remember that Bruce Lee quote where he's like, I fear the man who does one kick 10,000 times rather than 10,000 kicks once? Well, that's what I'm doing right now. I just do the same video over and over again, and that's how, people are like, wow, you're so fast, like Jackie Chan, right? And again, side comment, is there any martial artist who's comparable to Jackie Chan these days? I mean, the last one I remember was the Thai guy, Tony Jaa. Like, that was the one who stood out on my mind, who was like a super martial artist. But, what's some good martial arts films nowadays? I want a new Rush Hour, you know what I'm saying? Remember Chris Tucker? He made so much money and then he owed the IRS, and then kind of like I think he did the Wesley Snipes thing where he just didn't pay his taxes. But side note, okay, so now let's go back to this whatever we're doing. So the actual velocity banking strategy is your pay check, your entire pay goes into a line of credit, and then your expenses comes out of that line of credit, right? And then after every single month, this your cash flow is going to be your debt reducer. That's how much the balance of debt is going to be reduced by, along with the top sum interest on that line of credit, because the bank is going to charge us for that line of credit. So we got to pay it every single month, right? There's that access fee to help us manage our finances, which we're going to do as we're paying off debt, right? So now let's go ahead and do this. So this is J2 plus 1. And then the next month is the previous month's balance plus the previous month's interest minus, what was our cash flow? 4701.35. 4701.35. Okay. And then what we're going to do is we're going to take the average of these two numbers, right? Because again, estimated average daily balance, multiply it by the interest rate, 0.1, and divide by 12. 10% right here, divide by 12 to get the monthly. I talk about these formulas every single time. So because I say the same thing every single time, hopefully you try practicing them, right? You know why I'm so good at this? Because I make a video every single day, and that's what you got to do too. So let's go ahead and copy these formulas, and then they tell you when they get paid off. And you can see, because I got the former highlight streaks, it's going to be paid off here, and then wabam, right? 43 months. 43 months we paid off all that debt, and we're at like a negative $644. So let's kind of write this as a milestone and figure out how long it's going to take us to go apply on that Dave Ramsey show to do that debt-free screen, so that Dave can yell at us telling why we use a HELOC. I'm like, dude, Dave, I couldn't use step one. I can use baby step one where I saved $1,000, right? Clickbait. Anyways, so let's go ahead and just write it down. So 43 months to pay off $167,000 of debt, right? $167,000 of debt. Now, the last thing we have is the mortgage, right? So we have two options when it comes to the mortgage. So we got this $4,700 of cash flow, which will just sit up in our savings, and we have two options. We can directly pay from our savings or checking into that loan, which is a very viable option. But the thing is that the loan is a one-way street. So when we put that money in there, right, we can never take it out. And that's what scares a lot of people with loans, because they are essentially a one-way street. And if most people did step one, or not step one, choice one, which is, if you're going to overpay your loans directly, do it. I think every mortgage in this country would be paid off in like 7 to 10 years. That's just my opinion, right? But why is it that these loans that are 30 years last till 35, 37, 40, 50? It's because we got to refinance because we run into cash flow issues because of that one-way nature, right? That one-way nature of the loan is kind of like a Netflix account that's really cheap, right? Because loans have cheaper interest rates than lines of credit. Lines of credit interest rate 10%, but the loan interest rate may be as low as 2 point something, right? Why is it so cheap? Because it's like a Netflix account where you can access from 1 a.m. to 6 a.m., right? And you can never watch any of your Netflix programs after 6 a.m. So there's a huge inconvenience there, even though it's the cheapest account plan. That's what a loan is. It's a one-way street. That's why they price it so low to 6 or 3%. So, but another way that we can do this and overpay is just transfer some of that money to a line of credit and then dump your entire paycheck. And then now you've made it easier for you, right? You've made it easy for yourself. Because if you directly put that money into the loan, that's like a UPS left turn. Now, I don't know if you've heard of this. UPS doesn't like it when their drivers make left turns. They got software, I think, to make sure that they're always making a right turn because they know that left turns are dangerous, especially with that big truck, and they don't want to lose all of that shipment and all that good stuff, right? They don't want to lose all of their inventory and cargo because they made a bad left turn. They just have everyone prefer the right. And this is essentially the right turn of overpaying your mortgage is, right? So let's just let transfer, we'll just transfer $10,000 into that line of credit. And this doesn't really matter as long as we have the cash flow. And this is why we pay off our mortgage last. We don't pay off our mortgage first. And there's no reason in general we need to replace our mortgage with the first lien line of credit. You see people saying, well, you got a 2% mortgage. Why don't we replace it with a 9% line of credit? In fact, somebody asked me if they should do that. And I'm like, what? Mind blown? Of course, I don't give financial advice, but I was just like, what? So let's go ahead and move $10,000, and actually this will be $290,000 of the mortgage into that line of credit. Let's go ahead and do that. So if we do this, right, $10,000, let me just go ahead and add that right here, plus 10,000, and we call this chunking officially. How long does it take to pay that 10 grand off? Only 2 months, right? Now you can do a bigger chunk based on your cash flow, and maybe you don't want to have to think about every 2 months, maybe every 6 months. You'll see that the results are very similar, even though when you make bigger chunks, because it's in a higher interest rate loan or line of credit, I'm sorry, you're gonna pay a little bit more. But the most important thing is that you don't replace your line of credit, or I'm sorry, your mortgage with the line of credit. You might hear it on the internet, but the OG 2003 Harj Gill, the one who come up with the speed equity system before Velocity Banking was known as Velocity Banking, he says you don't need to do that. You don't need to do that. And luckily, we have this Velocity Banking calculator right over here. So let me go ahead and switch screens. Give me one moment. There we are with the Velocity Banking calculator. We just got to put it in and we can figure out the debt payoff time. So let's just take a quick look at the loan details. So 300,000, right? 300,000 at 6%. And hold on, let me figure out what the balance of the loan is currently. I'm going to do that behind the scenes while you're looking at this beautiful Velocity Banking calculator from Renatus. All right, so it's 279,000. Oh, wait. No, something's wrong. It's let me go back here. 43 months. 43 months. So it's $285,712.64. So 285. So this is the calculation after 43 months, 712.64. 712.64. Okay. And then interest rate, and then 30, blah, 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 blah. Okay, we got it right here. And let me just kind of fill in the income. Again, we got that nice, ridiculous boatload of $9,000 a month income. And then how much is our expenses? Our expenses is 2,500. So everything except for the loan we're trying to pay off, 2,500. Now let's learn the most important lesson of the day. Do we need to replace our mortgage with the line of credit? Right? So you might have heard that on the internet, 285,712.64. And you see, woo, this is pretty good. Paid off in 4.6 years, and you saved $211,000 of interest. Okay, so let's take a look at this number here, 72,000. Now let's say I just did like a small $9,000 or $10,000 chunk, 10,000, right? Look at that, 4.2 years and 38 grand, right? Why leave money on the table by replacing our line of or mortgage or first lien mortgage with the first lien line of credit? No, I'm not going to do it, right? But 4.2 years, pretty good. So let's go ahead to our other spreadsheet and write that down. So we're going to do that right now. 4.2 years. So equals 43 divided by 12 plus 4.2. And that is 7.78 years debt free. Oh my goodness. And how much is that? It's 160. That's 467K of debt. Now, after 7.78 years, I can go to Mr. Dave Ramsey's website. And let's check it out right here. Mr. Dave Ramsey's website and schedule my debt-free screen. What's my name? It's Cam, and I'm in some city in Georgia, and not in Alabama. And what baby step? I couldn't even do baby step one. I didn't even do it because I didn't save $1,000, right? So Dave's, where's the other option, right? So if we scroll all the way down, what kind of debt? Did you sell your house? Blah 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 blah. How long did he didn't use Dave's plan? Sorry, used a HELOC. And yes, I did use a credit card because we didn't go over this in this video, but we use a credit card for our general expenses. But I didn't finance anything new, so that's a no, right? But please explain. Use Velocity banking, but still want to do a debt-free screen. Woohoo! All right, well, they'll probably never let me on the show. But yeah, that's it for today. So just another clickbait video with our favorite Mr. Dave Ramsey, right? All right, well, that's it for today. Have a great day. And if you're able to make it on tomorrow's live stream, 11 a.m. Eastern, we'll see you all there.